Well, greetings, my beloved clients and friends. Uh, it's been a couple weeks since I did a video. It's rattlesnake season. And I did one last week on Mother's Day, but it was kind of windy, so you couldn't hear me. So let's talk about what's going on in the markets and the economy right now. April was brutal, and May is starting to be as well. I think the core portfolio is down double digits in April, and so I want to talk about the bear case and the bull case going forward, and just a little trivia. Wall Street is often symbolized by the bull and the bear, and the reason where that comes from is that it's a picture of a bull and a bear fighting, and when a bull fights, he strikes up, with his horns. He strikes up. And when a bear fights, he strikes down with his claws. So the bull symbolizes an up market, and the bear, excuse me, I got the sniffles a little bit. A bear symbolizes a down market. And so the bear has been winning the fight lately. And if we describe the bull case and the bear case, they both have to do with COVID. And I think my conclusion will be that in the short run, it looks like the bear has the advantage, but in the long run, I think the bull has the advantage. So what's going on that's creating this bear market? And like I said, it started with COVID. And so when COVID hit 2 years ago, it shut down the economy, the world's economy. And federal governments and central banks around the world flooded the global economy with liquidity, with cash, brought interest rates to zero. And so it created this massive increases in asset prices. And so that money had to go someplace, and people couldn't go on vacation, and they couldn't go shopping, so they had to figure that money went into real estate, it went into capital markets, it went into home improvements, and it went into online businesses. So those areas where that money flowed into really flourished. But there was bound to be a day of reckoning when the spigot was finally turned off, right? When that massive, because unless they keep printing the money forever, one day they're gonna have to turn it off. One day they can only take rates down to zero, and so eventually what happened was they created so much demand, and then supply was limited because not everybody could go to work, and shutdowns, and there was problems at the ports that they couldn't get the goods out, and so supply was limited and demand was way up here, and so the supply could not meet the demand, and it led to inflation. And the Fed realized they needed to do something about inflation back in November, and they said, we're going to start raising rates, and we're going to start taking some cash out of the economy. And that's when the market started turning. And then in March, they said, we're going to aggressively start raising rates and aggressively start taking cash out of the economy. So that accelerated the bear market. And so they're just starting to raise rates, and they're just starting to take cash back out of the economy. So that means the pain is potentially just starting to. Now the market is forward thinking, so they started pricing in the pain before the pain came, and eventually they'll start pricing in the relief before the relief comes too. So, but the pain is just starting. So that could mean that the pain in the markets is just starting as well. So that's the bear case in a nutshell. Okay, so asset prices had gotten way elevated. And to give you some perspective, of what kind of asset prices we were talking about, it kind of hit me when I was talking to my son about, he's graduating this month. I'm very proud of him, and he's talking about starting a business, a jewelry business, and we started kind of planning the business and setting long-term goals, and eventually talking about, well, if you have a business that's growing in this type of market, a fast-growing business like the one, you go for like 10 times sales, right? So, and when I thought about that, I go, even if you had a great business and it's growing, but someone offered you 10 times sales, wouldn't you take it? And I started thinking about what that really means in real life and real money. And if that company had 20% margins, okay, that means that from their sales, 20% hits the bottom line. So if they had 10 million in sales, 2 million hit the bottom line, right? Which is very good. Very few companies have 20% margins. But if someone were to offer you 10 times sales, that means they'd offer you $100 million for this company with 10 million in sales. And they'd offer you $100 million for a business that has profits of $2 million, which would be 50 times earnings, okay? And I said, would you take it? And I said, they're basically gonna pay you what you made this year 50 times that. Meaning you could keep doing this job or get 50 years earnings today. Would you take it? Of course you would, because you never know what's gonna happen in 50 years. You might not be making that much in 50 years. So, and that's a reasonable valuation, where some of these companies were trading at 100 times sales and not having any earnings. Why wouldn't you sell it if someone was going to pay you that much? Right? Pay you what you're going to make in the next 200 years. They'll write you a check for it today. So that's a ridiculous, lofty valuation. Here's a normal valuation. Let's say you had a taco shop that has $1 million in sales and 200,000 is your take-home profit, right? Typically, if you tried to sell that business, you could get about 2.5 times earnings for it. They'd write you a check for 500,000 for that business. 2.5 times earnings. That means what you'll make in the next 2.5 years. Not 50 times earnings or 100 times earnings. 2.5. So valuations on these great, highly fast-growing companies were just way out of whack. And some of those companies have come down 80-90%. And they should have, so we're starting to look at companies now, and some companies are really cheap. Some good companies, after prices have gone down the way they have in the last 6 months, some companies are really cheap now, finally. But not all of them. Not all companies are dirt cheap right now. So this is definitely a buyer's market. There's companies that have good prospects, and they're a great company, but they're not a great investment, because the valuations, even though they've come way down, are still very high in some in some areas. Some have come down and they're cheap. So it's definitely a stock picker's market right now. But there's room, for broadly for an index, like the S&P 500. Not all 500 companies are cheap right now. So, that index could come down some more. So that's the bear case. The fact that as interest rates go up and the Fed pulls cash out of the economy, the pain will continue for a while. Okay, so let's talk about the bull case. And it also has to do with COVID. So COVID hit and it shut down the global economy. And people couldn't go to work, they couldn't go out to eat, and they couldn't. And there's a saying that necessity is the mother of invention. So people had to figure out how to do stuff from home. And I think a really good example is this company called Mercado Libre, which is basically the Amazon of Latin America. Now, Latin America is not as technologically advanced as, say, North America or US. And so not as many people were comfortable buying stuff online as they are in the US. So Amazon was probably 10 years ahead of Mercado Libre in terms of, market penetration and infrastructure and all these things. But COVID hit, and guess what? People had to catch up real quick. People had to figure out, how do I get my groceries? How do I do stuff? And reluctantly, they figured out how to do it online because they could. You could still go shopping online and buy the things you need. And so Mercado Libre took off. It was like you could say it was a godsend for them, that it forced all these people that they said, in theory, one day these Latin Americans are going to reluctantly figure out how to do stuff on their smartphones, Well, all of a sudden they were forced to. And so it was a boon to that company. Now, I've mentioned that I've been reading this book called The Wealth of Nations by Adam Smith. It was written, 250 years ago, early into the Industrial Revolution. And he talks about the economics of the towns and the economics of the country, and how in the towns there's a lot more economic activity because there's a lot more people in a small place, and so there's ability for people to specialize. Whereas in the country, because people are more spread out, the people in the country are more talented, quite frankly, because they have to do many things. You have to know how to do construction, and you have to know how to do blacksmithing, and have to know how to do animal husbandry, and you have to know how to do farming, and have to know how to fix a fence, and sew your clothes and stuff. Whereas in the city, you might just be have one specific task that's what you're focused on, putting the heel on a shoe. That's the only thing you know how to do. But there's work for that type of person. So the economics are way different, and there's way more demand for stuff in the city because there's much more people. So in the city, you could have a Vietnamese restaurant and a French restaurant and an Italian restaurant and a Mexican restaurant and a restaurant that just makes coffee and a restaurant that just makes donuts and a restaurant that just makes ice cream and a restaurant that just makes smoothies and a restaurant that just makes vegan food, and all right next to each other, and they all do really well because there's demand, because there's a lot of people. Where in the country that would never work, right? There's not enough people. All those businesses they'd go out of business. You have to be very general in what you do. So that dynamic of much more economic activity in the city versus in the country. So what happened when COVID hit, it was already happening, but it really accelerated. We essentially all moved to one city, and that city was the internet. We all worked from that city. We all shopped in that same city. And so if you think about the economy as one city, it was just an absolute boom or boon to the global economy. And then it was just, they threw gasoline on it with all that liquidity, so it just exploded, and there's massive demand shortages and massive inflation. And so I think it's going to be very challenging for the Fed to slow down that runaway trade. They're going to have to really pull hard on that lever to bring demand down. They're going to have to really shackle demand by taking money out of the economy and raising interest rates. And it's still going to want to keep going because, like I said, everybody moved to the city, and there's massive amount of economic activity in this global community that's the internet. Meaning, I could go on Amazon or whatever, and I could shop any place in the world, and it'll be on my doorstep very shortly, you know. So, and if I'm a business owner, I could have customers anywhere in the world, right? And I could also hire people, if I'm going to start a business, to work for me from any place in the world, right? There's no limits. And you go on Fiverr and you could hire people to do stuff. Like, I had people do my Christmas invitations, and the guy was in India, and, you know, for $15 he designed my Christmas cards and stuff like that. And here's the interesting, in India they speak English, and in Nigeria they do too. And so those countries are booming because, I mean, if you talk to them, you could barely understand them. But if they type in English, and it sounds and looks just like regular English. And so I think the bull case, there's like a gold rush going on. The ability to start a business and to do commerce globally has become so easy, so incredibly easy to get a website and to have it designed. And there are companies that are providing the infrastructure, if you will, the picks and shovels for this gold rush. And those are going to be the clear winners. Now, some of those companies, it was obvious that they're going to be the clear winners, like Stripe and Zoom and companies like that. And their prices got way out of whack. Even though it's a great company, and even it's going to be a huge success, you still don't need to pay 100 times sales for it. That's out of whack. You're paying in advance for the next 50 years of earnings, assuming they continue to grow the way they have been. That's a huge assumption, and even if the assumption is right, you're still paying way too much for it. So, but, you know, eventually they're going to get priced down to where it's like, it's actually a fair price, because it's still a great company. So the bull case is that we've become one city, and that the economics of that are going to be very good. So how do you slow down inflation? You're going to have to either bring demand way down, which is unnatural because this thing wants to grow, or you got to bring supply way up. And so when there was a problem in the early 80s with inflation, when Reagan got elected and Paul Volcker was the Fed chair, Paul Volcker raised rates dramatically, and you can get like 15% on a CD at the bank because he raised interest rates so high to slow down inflation. And so he was pulling down on demand. He was shackling demand by raising interest rates that high that, you know, why would someone go borrow money at 15% to start something when they could just make it at the bank and do nothing? So he was trying to force people to do nothing, just sit on your money in the bank. And then Reagan said, okay, I'll help you on the other side, because he was a supply side economist. He said, I'm going to unleash supply, because the problem with that caused inflation was demand was way up here, supply was down here. So Volcker said, I'm going to bring demand down, and Reagan said, I'm going to bring supply up. And how do you bring supply up? You take the shackles off of the producers, right? So Volcker was putting the shackles on the consumers, and Reagan was taking the shackles off the producers so that supply could come up. That's Say's law. Supply creates demand. So I think the better way to fix this is to increase supply, is to get products moving, take the shackles off of business, let them supply more stuff to this insatiable demand, and that's the possibility for a soft landing. I don't know if they're going to be able to navigate it, because in '81, the Fed and the government had to work together, and it worked, and it created a decade of incredible prosperity without inflation. That continued actually 2 decades, the 80s and 90s in general, 20 years of pretty good economic activity. I mean, there were some pauses and dips along the way, but it was generally a 20-year ride up, with the big exception of that one bad day in 1987. But that's the bull case, is to look for those companies that are going to provide the picks and shovels, because there will be a lot of people that want to get in on this gold rush, right, and start an online business, right? And a lot of them will fail. But before they do, guess what they're going to have to do? Go buy picks and shovels, meaning go pay for someone to do their website and all these services that they need. So those are the companies that you want to look at, that are providing the quote-unquote picks and shovels to all this economic activity in this global city. Okay, and so let me give you an example. So the way it's been is, if you want to go shopping, you go to the mall, right, and you buy your stuff. And so there's 3 players in that. There's the stores at the mall, the retailers. There's the landlord of the mall that owns the real estate, and then there's the consumer, right, that goes there and shops. Well, Amazon came along and said, you don't have to go to the mall to buy that stuff. You could buy it from the convenience of your home, of your smartphone, or on your computer. And you have better prices, better selection. It's more convenient, as long as you could wait till tomorrow to get it, right? So it displaced a lot of that need to go to the mall. And so Amazon replaced a lot of those retail companies. So who replaced the landlord was Apple. Your phone is the mall. Amazon is the store at the mall, right? So Apple is the place where the stores are. So, and to let's Google, which is, they're the Android operating system. Those are the 2 big malls where people put their store. And so those are the companies that create this virtual mall, because everybody in the world, it's amazing when I say everybody in the world, even in third worlds, people have smartphones. There are businesses in Africa in these villages, where people have a car battery, and their business is to charge people's smartphones, right? To recharge them. Because these people that have nothing else, they still have a smartphone. So, and they could be your customer, or they could be your merchant. You could buy stuff from them, or you could sell stuff to them in this city, because we're all citizens of the same city now that we all have an internet connection. So when we think about investing, we think about, who are the companies that are selling the picks and shovels in this new economy, because those are going to be the stable companies. But we don't want to pay too much for them. And it got to the point where last year the price was way too high, even though it's a great company. Some of those companies are down 80-90%, and they're starting to look attractive. Not all of them attractive in terms of price. They're attractive in terms of a business, but not yet attractive in terms of a price. So, but long term, once this unrealistic pricing works itself out, there's going to be good opportunities again. That's the bull case of this exciting economy that is like we all live in one city. The bear case is the tightening is just beginning. So we're going to have to navigate through that, and we're doing our best. And we probably should have been more aggressive of going defensive when it started, but we'll do our best to navigate through it and grow and preserve your wealth long term. That's our goal. So have a great day.